Welcome to the Become Sensible podcast, where we discuss practical accounting, finance, and tax for everyday business. I'm your host, Fiona, and I'm here to show you that no matter what your business financial situation is, you can change it. Good morning. Welcome to Become Sensible. I'm your host, Fiona, and today we will talk about a very common question and topic that small business owner ask us, that is S Corporation. What it is, why it matters, and how you can use it as a tax strategy to help you to save in terms of tax and building wealth. And so let's talk about it. And there's a lot of confusion about S Corporation, and everyone asks the question. So let's clear up. And if this episode will be too long, then I will cut it up into 2 episodes. But let's dive in. Number one, what is actually an S Corporation? So S Corporation is not actually a business structure, but S Corporation is the way that you select your entity to be taxed as a subchapter. And the IRS give this S stands for the subchapter in the Internal Revenue Code. And this is basically the way that you tell the IRS that I want to be have a special tax treatment. And this special tax treatment is just only for small business owner. So what makes an S Corporation unique? That is because it has the combined benefits of incorporation with the pass-through tax entity. As you know, pass-through tax entity is you don't need to pay the federal income tax when you file the tax for that. It just will pass through it into your K1 or your Schedule C, go into your personal tax return. What S Corporation is pass through the K1 to your personal tax return, and you pay tax on your personal tax return, not on the corporation tax return itself. So you remember it, C Corporation, they need to pay tax on their tax return on federal or the state. But with S Corporation, it has the benefit of pass-through entity. So when you file the S Corporation tax return Form 1120S, you don't need to pay tax on the federal return at all. It flows through your K1 and you will file it and pay the tax on your personal return. So number 3, let's talk about what is the key component of S Corporation. First, it has a limit in terms of number of shareholders. So you only have up to 100 shareholders as the owner of S Corporation. And this is one of the reasons why if you start a company in the future, you want to raise funds through private equity, to angel fund, through public, IPO public raising fund, issue the stock on the stock market, you cannot be an S Corporation because it limits the number of the shareholder. Number 2, you only have one class of stock. And this also contributes the reason why if you want to raise funding in the future, S Corporation is not for you. You need to be a C Corporation because you have a different class of stock. You have a number of shareholders, can be thousand of them. And number 3, S Corporation cannot be a partnership, a C Corporation, or a trust, or anything. It needs to be an individual. And these individuals need to be a U.S. resident or U.S. citizen. So, and then finally, you need to have formalities like a C Corporation, you issue the stock, you holding the board meeting, you have a meeting minutes, you need to file annual report, and you need to maintain the records. So what is the tax advantage of an S Corporation? So one of the main things is self-employment tax. You know that when you have a single member LLC or you operate your business as a sole proprietor, your tax is calculated based on the net profits of the business. So remember, taxes on the net profits, regardless how much is your revenue. Even you make million dollars in revenue, but because all your expense is too high and the business have a operating loss, then there's no tax calculated on it. But if you only make $100,000 in revenue, but your profit is 80,000, that 80,000 is where your tax start calculated. So remember, in tax, we talk about net profits. We don't talk about the revenue at all. Even though in terms of financial revenue is very important, but in tax, that's just where it is. So when you have a sole proprietor, you have a single member LLC, on your profits, you need to pay self-employment tax, which is 15.3%. So what is self-employment tax? Is including Social Security and Medicare tax. With an S Corporation, you can split income in two parts. A reasonable salaries, which is you pay the same employment tax on that. And then the second part is the distribution to the owner. This is where you don't need to pay self-employment tax. And the other thing is you just become an employee of your own company. With an S corporation, so your salary to pay yourself is become deductible is spent on the business. Any benefit pay for you, like retirement accounts, any like other benefits that person benefit that go with this, like health insurance, dental, all of this become like tax deductible on the S corporation return. So it's reduce your profits. It's even more in terms of S corporation. So one of the simple example that let's make is a simple example to like easy to understand. For example, if your business make your profits is $100,000. So you decided that you pay for yourself a reasonable compensation is $50,000. This is example. You pay 15.3% on that salary, the reasonable compensation that you issue yourself W-2. You pay that 15.3%, which is $15,300 in terms of self-employment tax. And then the rest of it, that distribution will be $50,000. You don't pay tax on that part. So you basically save half of your self-employment tax, which is around $76.50 on the self-employment tax on this example. So now like you understand like what it is, what is the features, what is the benefits. So who should consider as an S corporation? Because like as you know that not everyone is suitable for S corporation for any entity structure because it's suitable for certain situation and certain business condition. So here's a couple conditions that should consider for yourself. Number one is your business consistently make profit. Number two, you make in money that tax saving will outweigh all the costs, additional costs in administrative costs. Because remember, if you have an S corporation, it needs to file tax returns separately. And depends on also like the state, there's a couple other like regulation and requirement that you need to compliance with. So if your tax saving is outweighed all these costs that you need to like maintain as corporation, then do it. And then you need to plan tax distribution from the business regularly. And number four is you need to have like the S corporation is reasonable compensation. It needs to be calculated and have a strategy go with it. So your distribution and your reasonable compensation, it needs to be make sense because the IRS will not let you to do it like easily that you can like take advantage since you pay for yourself, say like $10,000 or $20,000. It needs to be reasonable. Otherwise, it will raise a red flag and they will like force all your distribution become a compensation to yourself too. And that is where you need to pay self-employment tax. So then you rip up the benefit of the S corporation itself. And then with all of this, however, it's not like might not right fit for you. If number one, you just started out with your business. Number two is your profits is less than like $40,000 or $50,000. I normally calculate and advise clients start consider when your net profits pass $50,000. But like below that, it's not makes a lot of sense to like maintain an S corporation. Number three, if you want to raise funds, you cannot do it at all. And you can't justify paying yourself a reasonable salary because when you run the payroll for yourself as employee, you need to pay for a payroll processing fee and all these regulations go with it. So make sure that you have the cash flow to help you to run the payroll consistently too. So then now we talk about like what is like very common misconception about an S corporation. So number one, S corporation doesn't like actually like additional liability protection for you to like more than like a regular C corporation or single member LLC. Number two, reasonable salary is actually very important. You basically need like a professional person that who can help you like calculate it based on the areas of where you live, the living costs, the amount of work that you need to deliver in terms of like relate to your skill set or any other like administrative, this formula to like actually calculate it. And when you make it, the calculation is makes sense. Then in the future, if the IRS say that this reasonable salary is not make very sense, then you have a proof that this is actually calculated and have a real consideration on it, like the reasonable cost come to this calculation. The tax benefits is not automatically happen. It depends a lot in the tax strategy. And that's why you need to have someone like our company we do is we actually have a tax assessment and we will like place different scenario for you to see, okay, if you pay this salary, that's how it look like in terms of distribution, how it look like in terms of other benefits like retirement contribution, any other factor, and how your total tax liability situation will look like. Because reasonable compensation and distribution is not automatically. There's no one answer fit for everyone. It depends a lot in your situation, in terms of your personal situation, and also depends on your business. So need to make sure that this is a part of like calculation. And sometimes if you compensation too high, it would trump you into the next tax bracket. And thus you lose the benefits of actually like in the tax brackets that beneficial for your overall tax situation. So that is where I need to like consider about tax planning and tax strategy to help you navigate that calculation and assessment and scenario analysis. Normally, our clients will come and ask us upon a bunch of questions, and we put in scenario analysis for them and give them, okay, this is what recommendation. And if you do A, what happened? If you do B, what happened? If you do C, what happened? And this is where you actually capitalize on the benefit of an S corporation. Finally, let's dive into what really matters when choosing between an LLC and an S corporation. In my career, I see a lot of business owners like when they switch to an S corporation, they save $10,000 in tax. But there are also some of the people that in their business situation, in their personal tax situation, is actually more beneficial for them to be in a single member LLC instead of become an S corporation, because it depends on the stage of your business and also your personal finance situation too. So let's talk about a couple phase and couple like stages. Level one, you just started now, your business make the profits and earning like under $50,000. An LLC make more sense because it doesn't need you to requirement all other administrative costs to maintain an S corporation is number one. Number two is lower compliance costs. And it also like the saving in terms of a S corporation is not outweighed. the cost, that administrative costs and tax filings and the burden of compliance is almost equally. So there's no reason you should like turn it on to become an S corporation at all. And an LLC is more flexible for you, like in terms of like figure out your business model, and also like in the future, what is where there like you need the funding or like capital and all those things. So I don't know whether that's just take you 6 months, a year, whatever. But if your business profit is in the range like below $50,000, stay there and figure it out in terms of like what you actually want in terms of the business side of it. Like, what is your business strategy? What is your business model? What is the thing that you want to do and go with your business? Because end of the day, tax coming in and play on the profit. And the business model is not because of like it should go first at all. On the business side, need to figure it out first. But once you go and you figure it out that part, the tax planning and tax strategy can come in and like help you navigate within some of like tax saving. Level 2, like your business growing, and after always spend your profits is around like 80 to 100,000 in the profits. With 100,000 in the profits, apparently an S corporation is made more benefit for you than just a single member LLC or a sole proprietor. But you always know that an S corporation is need more in terms of accounting costs, administrative costs, and payroll processing and compliance requirement. So if you have a great accountant or CPA, this is what help you to save in terms of like become an S corporation compared to like just a single member LLC or like a partnership. Level 3, your business is growing and you have a lot of profits. It's like 300 plus or even more than that. You at this time, if like a lot of in terms of profit, you can like hire a general manager, a CEO, or someone coming and manage the business for you. You just not working in the business, but more in terms of working on the business. And now, because you not manage day to day of the business, you actually can take more distribution compared to like reasonable compensation W2 because there's someone else is active, manage for you in terms of the business. And it's like when you take more distribution, you pay less in sales from tax too. It's just a great strategy in terms of the workload for you, but also in terms of like tax strategy, and that you can take that distribution to pay for your personal finance and requirement and obligation, but also you can move that profits to do other things like investment in other things, and that is a great strategy and state to do. But of course, that go with the business grow. So that just depends on your business strategy and business financial situation. It's not going into this tax saving strategy at all. But in other episodes, when I talk about like financial growth, scaling financial and all of that in terms of the business, I did mention about like strategy help you to like grow and scale the business up to that level. So there's a couple common mistake that I see that people make in S corporation and need to be avoided. Number 1, you select become an S corporation too early. If like the profits is small, don't switch to become an S corporation right away. Figure it out in terms of your business strategy, in terms of business financial situation, and in terms of structure, what you actually want for. And that is once you figure that part, you can become an S corporation later. But the other thing is like there's some company that people start and they know that, okay, they will start this business to like raise fund and or go public or like any like sell it in the future. So they become a C corporation right away. So that is like a real conversation that you need to talk to CPA, your lawyers, the people help you to set up the business entity. Make it clear. If you know where you want to go, make it clear that, and it's easier before make the decision. But if you're not, and the idea that you bring into the market is too new, there's so many other things in terms of the business, you want to figure it out, don't switch to become an S corporation right away, because the cost for you to switch backward and then doing all of this is cost money to actually do that, like $10,000 just to like switch back and redo many different things. So make sure if you know where you go, select it right away. And if you're not, then it's like figure it out in terms of the business before you do it. Number two, and obviously there's many people don't understand this, it's like very critical, because S corporation is set to help you to save in terms of self-employment tax. Like you may have a price, sometimes just 1/3 of the price in terms of self-employment tax. Then the IRS always pay attention in terms of how much is your distribution, how much is your reasonable compensation. And if your reasonable compensation is too small, they will raise a red flag with the IRS, and they can basically like take your distributions and say that should consider as a reasonable compensation for you. So need to be careful on that part, that your reasonable compensation, it need to be reasonable and it need to calculate it like in correct way. Number three is consider future plans, like because S corporation is not for every business model and intention. If you want to raise funds, make sure that you don't actually use an S corporation at all. And if you want to sell the business, it's actually a little bit more difficult. If you sell it as an S corporation, then it's a C corporation or like a single member LLC. So it depends on the industry, the intention, the plan that you want, your exit plan with the business, or like in the future, whether you want to raise funds. Then doing is like make sure that it's actually follow this plan before to become S corporation, because you save $10,000 or $20,000 in tax every single year, but then eventually you need to pay all the fee to like reconvert it, and it doesn't work it, and you will not have enough time, because if you select it, it's S corporation due date is March 15 of every single year. If you want to be effective to file as an S corporation for that tax year, the due date is March 15. So for example, over here, like 2024, if you want to become an S corporation and treat it as S corporation, the due date to select it is March 15, 2024. After that, it will fall into the next tax year, which is 2025. So it's the same thing. If you want to change S corporation status, you need to communicate and file the form. All of these take time for communication with the IRS. So that is why you need to like actually plan ahead of the time. You're not gonna be like suddenly like one switch to become an S corporation, and not gonna be happen right away at all, and it's follow their requirement and their timeline. So make sure that you plan it ahead and know where you want to go with the S corporation. There's a ton of strategy go with the S corporation that normally we do for tax plannings for clients, is like in terms of like not only like reasonable compensation with their retirement contribution, with their health insurance, with their rent and home office deduction. So one of the most common thing that I see is like, okay, home office deduction. If you are a S corporation owner, it's totally different from the single member LLC. And I think the tax law in that was went into effect in 2018. It changed the situation. So basically, if you don't have any outside office beside your home, like for example, like me, we have an office that where we conduct all of the business, like main business activity is outside of the house and in that office. That is where I rent is. And I cannot take the home office deduction from my home office at all. Even I work, occasionally I work 20-30% of my time from home because it needs to be primary. So your home office, if you want to take the deduction, this is the thing. It's not like coming in and take directly from the business, but it's considered like a reimbursement because now you are considered an employee of your own company, and for the convenience of your employers, which is your company, you as employee, you can take some home office deduction, but it's basically considered is as a reimbursement from your business to yourself. So, and this need to meet the requirement that you conduct most of your business activity like primary at home, needs to have like separate space that is just delegate for that work, and it not can be like share it with other people, or you can like sit not on your kitchen table like something. It needs to be dedicated space for the business activity for you to actually get that reimbursement, and they have a ton of like other conditions go with it. But one of the things that needs to pay attention in those two, if you want to take the home office deduction, and then it needs to be like calculate, you need to think about like strategy in terms of like retirement contribution, strategy in terms of health insurance. Like there's a ton of other strategy that you actually like can do with the S Corporation. And maybe in the next episode or so, I will have like a separate like a episode talk about like strategy in terms of like as an S Corporation owner. I hope the information about S Corporation you can see that it's offer you a lot of advantage in terms of your tax, but it's also come with like responsibility, cost, and compliance requirement. So before you make a switch to become an S corporation, make sure that you talk to a professional person like CPA that can analyze your specific situation. And one of the things is I don't see people do this very often on the market study. Actually, analyze the scenario. When you do A, what is the situation look like? When you do strategy B, what does this situation look like? And that is one of the best way to do tax planning and tax strategy, because this gives you many like option and clear pictures, the result of certain action that you take on. So make sure that you talk with a professional or CPA that actually help you clearly on in terms of strategy and what is the result of it. And I hope this episode is super helpful for you. Thank you so much for your time today, and I cannot wait to see you in the next couple episodes.